Let me show you exactly how I explain closing costs line for line with no fluff. And if you stick around to the end, I'll give you this exact sheet for free. I'm Jim with Treeside Financial. I've been in this business for a very long time. And one thing that I've always found when anybody's thinking about doing a refinance, they have no idea how the fees work, how the loan amounts and payoffs work together. And oftentimes, if they're not working with a very experienced loan officer, they get surprised at closing with a whole bunch of money they have to bring because the loan officer didn't calculate the figures correctly. Well, I'm going to fix all of that right now in the next few minutes with this video. And again, if you watch to the end, you can grab the sheet for free and run the numbers yourself. Stick around even further and I'll talk about how I'll just do all this for you. All right. So I've got this closing cost worksheet I've prepared to make this really simple and easy to follow along. And I've plugged in a basic scenario. So here we go. You can see the initial loan amount. This is the current loan. This particular borrower had a $225,000 loan that they took out a few years back at a current interest rate of 7.5 on a 30-year fixed. The current balance is $200,000. Now, sometimes people are asking, where can I find this current balance? This would be right on your current mortgage statement. It should be listed right on your current mortgage statement, or you could log in online to your current mortgage servicer, the company you're making payments to, and they should list out the exact principal balance as of the day that you're looking at it. Now, every time you make a payment, this balance should come down a little bit. So it's important to note that what it was 6 months ago is not what it is today, is not what it is after you make the next payment. Constantly changing. Now, here's the tricky part. Now, this is very, very important. Every day that you own a mortgage, you owe interest on that mortgage for 1 day. So your current mortgage that you have right now that you're thinking about refinancing, you're paying an interest cost every single day. The amount of that depends on the previous month's balance. That's essentially how it's calculated. And in this case, if there's a $200,000 balance at 7.5%, that means that you are paying $41.67 per day of interest. So when you go to pay off your mortgage, if you pay your mortgage payment on the first of the month, let's say, for example, you pay your payment on May 1st. Well, that payment paid all of the previous month's interest. So it would have paid April's interest. And then on May 1st, when they receive that payment on May 1st, you owe 1 day of interest, May 1st interest. On May 2nd, you owe 2 days of interest for May 1st and May 2nd. On May 3rd, you owe interest for May 1st, 2nd, and 3rd. So you'd owe 3 days interest. So again, every day that you have a mortgage, you pay 1 day of interest to that mortgage. And when you make your payment in this example of June 1st, that's when you'll pay all of the 31 days of May's interest. And it goes like that, continues on. So this is one number that people get tripped up on, is they see that they owe $200,000 or 180, whatever the number is on their statement, and they think, well, I just need to refinance that 200,000. Yes and no. If you just refinance that 200,000 and you don't take into consideration the last payment that was made and the interest that's due since that last payment, then you're going to be short to closing by at least that number and maybe more, which we'll talk about in a minute. So in this example, I plugged in 15 days, assuming that 15 days has gone by, but you can play with this worksheet and put in 20 days, 25 days. Usually it's all the way up to 31 days. So that being said, you can see that when you change these numbers, the estimated payoff here is changing as well. Now, another note on the interest for the payoff that sometimes people don't think about, once I do educate them and teach them about these figures, is, they'll say, hey, Jim, I'm closing on, the loan and I only owe 25 days interest, but the title company is collecting 29 days of interest in the payoff. Why would they be collecting that extra $100, $150? And the simple reason for that is the title company that funds your loan. First off, if it's a primary residence, you're going to have a 3-day right of rescission period from the time that you close till the time it actually funds. So you've got 3 or 4 days there. In addition, the title company needs to get the money from the lender and send it out to your old lender with that payoff. So they often collect a cushion. They'll add a few days extra, knowing that if they overpay, your old lender will send you a check for the $30, $60, $40, whatever difference is back to you after closing, after they get payoff amount. So not to worry. the title companies are usually going to collect some type of cushion there, because the last thing you want to do is not pay off that lien. Then your new lien would take a second lien position and cause a whole another set of issues. So keep in mind your prepaid or your payoff interest is going to be typically have a cushion built in from the title company. So moving right along to the next part here, the new loan amount for this particular situation, I'm going to do what a lot of people often do is, again, they say, well, I owe 200,000, so my new loan should be 200,000. We're going to start there, and then we'll work backwards, and I'll show you how to adjust it to get it better. But we'll keep this example, say 25 days of interest on the payoff. You can probably already see that we're going to be short, but we're going to keep it here so you can see how much short it can be. And you're going to understand more of when you have an inexperienced loan officer that they don't understand how this all works and all the moving parts. That's how you can get in trouble and see surprise. You hear about these horror stories of, I was refinancing and I had to bring $8,000 to closing all of a sudden, 2 days before closing. I didn't know. Well, this is why you avoid all of that stuff. Anyway, so jumping back in. Now, let's say we are refinancing to 5.875. Let's say we paid off 5 years, so we'll go to a 25-year fixed. You've got a new payment here. Okay. Now, next set, we're going to talk about your actual loan costs. Now, these are the costs that you're going to incur by doing the new loan. In addition to the costs that are classified as loan costs, in other words, you're not going to incur these if you don't do a loan, there's other costs or other fees or other things that you're going to get charged for at closing of a refinance that even if you don't do the refinance, you actually are going to get charged for them anyways. We'll get to that in a moment. But in loan costs. Now, these are typically the things a lot of people are familiar with, so I'll kind of go quickly here. But there's a classification called origination charges, and these are essentially the fees that the lender and or brokers can charge. And you're going to see things like admin or underwriting fees, processing fees, as well as points, discount points, and or credits. So, for example, if you're paying for 1 point on the loan to buy down the rate to a lower rate, it's going to be 1%. 1 point is 1% of the loan amount. In this case, that $200,000 loan amount, 1 point would be $2,000. Now, if you don't want that lower rate, you could do a 0 point loan and eliminate that. And you can also you could also get credit. Many situations allow for the rate that you choose where the lender's going to issue an actual credit for that rate. It's basically the opposite of points. Instead of paying points to get a lower rate, you take a credit and get a higher rate by comparison. Now, that doesn't mean it's higher than what you have right now. It doesn't mean it's higher than market. It just means by comparison. So one side note, when you work with me at Treeside, I typically show all my clients options in both ends of the spectrum and let them kind of choose, and I help to guide them to what makes the most sense based on their situation. Quick rule of thumb, the longer you're going to stay in the home or the longer you plan to stay in the home or own the home, it makes more sense often to pay the little bit higher cost for the lower rate. There can be a payoff. There's a break-even analysis. That's if you're interested in learning about which option to choose and break-even analysis, and does it make sense to buy the lowest rate or should you take the lowest cost, or should it make sense for more in between? How to figure all of that out, watch the video. I'll post it right up here and also down below in the comments, but you can watch the next video on that here. All right, so jumping back into points, discount points, credits, you can see you change the figure here and it's automatically calculated. I'm going to keep this at 0 points. And that way I can also show you how, even though you do a loan with 0 points, you still can see a significant cash to close based on the loan amount. So we're going to jump right back in, and then you have your underwriting or admin fee. That's typically a fee that an underwriter or the lender is going to charge to pay the underwriters to actually underwrite the loan. That is also a fee that sometimes can be waived, but if you waive that and make that 0, you're going to see a slightly higher rate again as well. So rates and fees are, when it comes to origination charges, these are the fees that are tied to the rate. So the rate that you picked affects the origination charge. It's the combination of the two. Focusing only on the rate or only on the cost is not the correct way to do this. You look at the combination of closing cost and interest rate and how those two match up together, and you'll see that the well, when you're working with the correct broker or lender originator, you're going to see how they adjust accordingly. And the higher the cost, the lower the rate, and the lower the rate, the higher the cost. And it's a natural relationship. Again, watch the video I mentioned to learn more on what makes most sense for your situation. Okay, so moving on, the next section here is going to be the services you cannot shop for. Now, these are third-party items that the lender or broker are requiring you to use their vendor, and it's typically selected by the lender for the most part, but sometimes things like credit reports or some smaller things can be broker as well. But the appraisal fee is one of the most common fees everybody knows about. And more these days, there are options to waive the appraisal fee if the property is acceptable based on the data that's out there and the computer systems that are available. If you want to learn more about how to get an appraisal waiver, I've created another video there. You can watch it here. And okay, so moving on, so you've got the appraisal fee, which if you get the appraisal waiver, that could be zero. It could be $500. Typical average is $600. If it's investment property with rent schedules, it's going to be more in the $800, $900 range. I'm speaking specifically to the state of Michigan because that's where I focus all my business on. It's where I'm born and raised, and this is where my company is based. In addition to that, you'll typically see things like credit report, and then you'll see some other minor fees. These are going to vary slightly from lender to lender, but this gives you a general idea. And then section C here of loan cost are fees, services that you can shop for. Now, these are going to include your title services, title settlement, title insurance, etc. As a broker or lender, as an originator, we have to disclose the estimate from at least one entity that we work with for you, and you can choose that one. But if you wanted to go shop around and try to find a better one, you're welcome to, you're able to. You just have to make sure that they're going to be compatible and work well with whichever originator you choose to work with, and that can be a big deal. In addition, sometimes there are certain incentives to use specific companies with specific lenders for title settlement, and again, those are questions ask your originator about, but these are typically you're going to have some type of settlement fee, a title insurance fee. In this case, as you're seeing on this disclosure, this is a all-in-one fee from a provider tied to the lender that gives the borrower the ability to do an e-closing, online closing, includes title insurance, settlement, title search, all of the necessary items. But oftentimes you're not going to see that one single one. You're going to see something more like a fee for the lender title insurance, and then maybe a fee for settlement, and then maybe a notary fee to come close the loan. Okay, so here's an estimate of title fees. You might see something. Actually, the loan amount that I plugged in, I know this is a little low on title insurance. That's going to be closer. Okay, that might be your traditional title insurance. Again, these can vary slightly, but you're going to find they're generally in the same ballpark of figures here. All right, so all of these three sections, the origination charges, services you can shop for, and services you cannot shop for, are going to total the total loan costs. So this number right here is the total cost of doing the loan. Now, I just broke down each of those three sections for you. So we're going to jump right into the next part. Now we're going to talk about other costs. I mentioned a little bit ago that you have other costs involved that they're not considered closing costs per se. One of them is kind of quasi, when they set up these new disclosure fees and where they place things, some things got placed in my opinion, maybe not the best spot, but taxes and other government fees. In a refinance, you're typically going to have some type of recording fee. Now, again, that's recording the new mortgage. I have an estimate of $85, which is going to be pretty accurate for the state of Michigan. Other states might be much higher. It depends on what the counties charge for recording the actual mortgage into public records and how long the mortgages are and so on and so forth. But again, in my opinion, that this one should actually be moved to a different spot, but it's not. So we're going to jump right into prepaids. Now, prepaids are just that. So if you remember earlier, I talked about the payoff mortgage. If you remember earlier, I talked about the mortgage statement that you're paying off for that mortgage that you currently have. In fact, let's jump right up there. And in this case, I'm assuming 25 days of interest added to the principal balance to pay off the mortgage, right? As I mentioned, every day that you have a mortgage, you have to pay 1 day's interest. So when you close this, and that includes your old mortgage that you currently have and the new mortgage, and there's going to be a couple days in between where you technically have 2 mortgages, you're paying 1 day interest to both for a couple days. The little overlap, the 3 or 4 days in between the title company closing, funding, and actually sending out the payoff, that's going to be that couple days of overlap. So that being said, your new mortgage, you're not typically closing and funding exactly on the first of the month. Technically, you could, and if you do that, you can do, that can be the exception, and we can talk about that later. If you have questions about that, I can create another video. You can drop a comment down below if you're curious on that, or reach out and I'll be happy to explain to you. But the bottom line is usually you're not going to be closing right on the first of the month to the new mortgage. If you did, technically, then you would have 0 prepaid interest days. But what's more than likely is you're going to close some other day and you're going to have to pay the daily interest on the new mortgage for however many days that you're living in the home or that you own the home until, or that you have the new loan on the home until your next first payment is due. So let me give you the example. I mentioned earlier about May. So let's say we were closing on May 10th. Okay. So let's say we closed the loan on May 10th and you fund the loan on May 14th. Okay. That means your very first payment is not going to be June 1st. It's actually going to be July 1st. So your first question there might be, well, wait a minute. Why wouldn't it be, if I close on May 14th, why wouldn't June 1st? That's the next time it's the first of the month. And the simple answer is, on June 1st, you do not owe 30 days of interest, 31 days of interest for the month of May, because you closed on May 10th and funded on May 14th. So on May 14th, your funding day, May 14th, is when you start, that day, May 14th, is the first day of interest that you owe to the new mortgage company. So it's less than the full month's date of interest. So your payment, technically, if they were to collect, which they won't, but if they were going to collect for June 1st, they could only collect a partial payment on June 1st and then have to collect the full payment on July 1st. And therefore, moving forward, the full payment, all the rest through. They're not going to do that. So what happens is instead they say, okay, you're not going to have a June 1st payment. You're not going to make that June 1st payment to us. And incidentally, you won't make a June 1st payment to your old mortgage company, but you do still owe the interest for every single day of May that you have the mortgage. So in this case, May 14th, all the way through May 31st. So 16 days of prepaid interest is collected at closing. I'm going to say that again so it's clear. If you fund on May 14th, there are 16 days left in the month of May. So May 14th, May 15th, May 16th, all the way to May 31st, you're paying interest to the new mortgage company. And that new mortgage, the way you pay that interest is at closing, they're going to collect the interest that's due for the month of May for those 16 days. And then your first payment that you actually make the full payment is you're not making it in June because you already paid all the interest. On June 1st, you technically would have made all the cut. So you're not going to make a payment on June 1st to your new mortgage company. It's July 1st. And when you make that July 1st payment, you're paying the month's interest of June. So the odd days in May, you pay in this prepaid interest at closing. So that's where this prepaid interest comes into play for the closing costs. Now, incidentally, here's the benefit. Your daily, this is a quick, easy way to look to see how much you're actually saving on a daily basis is looking at your daily interest cost. So the new loan is only $32.64 per day, and the original loan is $41.67 per day. Now, by itself, it's not a lot it doesn't seem like a big difference, but if you add that up to 360 days a year or 365 days a year, you'll see that it's quite a bit of savings. Okay, so jumping back, you have $522 in prepaid interest in this case. Okay, now the next step, and by the way, as I mentioned, this whole section from here on out, including this figure, these are things that if you don't refinance, you're still paying interest every single day. It's just that in this case, like in this example, you're paying $41.67 per day, but by doing a refinance, you're actually dropping it to $32.64 per day. So the benefit is the savings of interest costs, and that's the whole reason to do it. If these two numbers don't go that way, if you're not going to a lower daily interest cost and you're not shaving off, some time, if you're not saving money or time for doing the loan, then I have to question, well, what is the real benefit? Why are you even considering doing a refinance to begin with? Anyway, okay, so next section, again, another part of the section that you're going to be paying regardless is escrow deposits. So, and you know what, I'm going to go back one moment. Other prepaid items, if your homeowner's insurance policy becomes due and payable in the time frame that you are doing your refinance, again, sticking with that May example, let's say your policy is due on May 30th, okay? If you're refinancing and closing and funding a loan on the 10th of May that funds on the 14th of May, then your policy is going to be due before your next payment, and you need to make that insurance policy to make sure you have coverage on the house. Now, if you currently have an escrow account, then you should have those funds sitting in your old escrow account from your original lender, which will get sent to you after closing, after they get their payoff, along with any escrow that they're holding for your property taxes. If you have an escrow account for property taxes, that money will also come to you after closing. Typically about 10 to 15 days after closing, you should get a check in the mail from your old lender. So that is something you can check into with your old lender by looking at your statement or even logging into their online portal, or I can help you with that as well. But that is key to understand. So anything that's becoming due and payable at the time can also be another cost. So let's plug that in. Let's assume this borrower had a $1,200 annual policy that became due and payable for the homeowner's insurance. Well, that's something that can pop up if you're not aware. Mortgage insurance premium, well, that is if you're doing a new FHA loan or some other type of loan that incurs an upfront mortgage insurance premium amount. Typically, if it has that, usually you can finance that on top, but that can then adjust your loan balance. But that's something to be aware of. I'm going to leave that off here because we're looking at just a standard conforming conventional loan. Property taxes due. This is another note of any property taxes that are due and payable, even if you have an escrow account. Again, if they become due and payable around the time frame that you're doing the closing, the title company has to make sure those get paid, or they could be a lien that takes over in front of the current lien that you're doing, the refinance of the new loan that you're doing. So the title company has to make sure those are paid. Again, if you have an escrow account, then that money should be sitting. In Michigan, it's typically not an issue until it's July 1st. If they're, between July 1st and December 1st, and within about, 30 to 60 days thereafter. Sometimes it can be 30 days before that. It depends on the exact county and city tax due dates as well, when they publish. But that is, and then the timing of your first payment. So if your first payment is before, if it's June 1st or before, usually it's not an issue for summer. If it's November 1st or before, usually it's not an issue for the winter taxes, but something to be aware of. Okay. Initial escrow deposits. Now this can trip people up too, because I just talked about all your prepaid items, but now we're talking about escrow deposits. Now this is your escrow deposits with your new lender. So this can be confusing because you're actually putting money in the prepaid at closing in your escrow deposits for future bills, not bills that are due right now or due within a couple of within a month or two of the actual closing funding date, but for the future bills. So if you have no escrow account, then you typically don't have to worry about this. These figures are going to be zero because you're paying your own taxes and insurance. But as a lot of people have taxes, insurance escrowed, this is very relative and very important to understand that you should have a balance in your old lender's escrow account. If you have an escrow account there, if you're setting up a new escrow account, well, you've got to fund the new escrow account. And the two different lenders don't often talk to each other, so you can't really transfer from one to the other. So you set up the new escrow account, you're going to get a refund of your old escrow account. And at the time that you get, and that's going to be about, like I said, 10 to 15 days after closing, that money can then go into, you can do whatever you want with that money, but what I recommend usually doing is paying it down into your new loan, into a new principal pay down. Or if you've used your savings and you want to replenish your savings with it, that's fine. Or, again, that's your money. You can do what you want. It's just that the lender is holding it for your upcoming taxes and insurance escrow payments when they become due. So in this case, I have the monthly amount. Now the bills are actually collected in Michigan. It's typically summer as the city and winter as the county. and it's typically July 1st and December 1st that the tax bills are due. And it's the full annual amount, not the monthly amount. But for determining how much to put in the escrow, we've got to figure out what is the monthly amount, how many months do they need to collect so that when they become due again, they have enough money in the account. In other words, the example I gave you earlier, let's stick with that. So I said May closing, first day of July 1st being your first payment. Well, if that's the case, then I really wouldn't need any summer taxes collected, but the summer taxes would have to be, I'm going to show you this calculation. So it'd be $3,000 in prepaids for summer taxes due here. Nope, not 30. It would really be zero. Now we're going to talk about the cushion that they'll collect in a minute, but so you can see that there wouldn't be any summer taxes collected into the prepaids, but let's talk about winter taxes due December 1st. Well, if our first payment is July 1st, that means July, August, September, October, November, December. So on December 1st, you're going to have made 6 payments, or in other words, 1/6 of the 12 parts to your winter tax bill. Or in other words, in this case, it works out to be half. So you're still going to need another 6 payments to start with, so that you add the 6 that you're making over the next 6 months, and then the 6 that you start with. So you'll have 12 months sitting there ready to go for your winter taxes, and you won't be short. Otherwise, what happens is the lender pays it, and then they turn around and increase your payment to make up the difference, and they adjust your escrow moving forward so that you don't become late, short next period. So very important to understand that your property tax escrow account, it's your money, but the lender's responsible to make sure that is paid for your taxes and your insurance, and there's no late payments, or I'm sorry, no shortages happening. So another quick note here is you're going to have, the lender is typically going to add 2-month cushion to both the summer and winter taxes. And if they're collecting for homeowners insurance escrow, then they're going to have an additional 2 months there as well. So typically it'd be like the 2 here. Okay, so you can see at $100 per month, collecting 2 months cushion, be about $200 into escrow. Now, 2 months, because as I mentioned earlier in this example, I showed you that the insurance is currently going to be due in May. And I explained it that way, showing you that you could have $1,200 due to the homeowner's insurance. Now, in this example, one thing to also note is with this much stuff becoming due, this should give you a quick reference of what should be in your escrow account. So you should have around $1,200 for homeowners insurance. You should have around $3,000 for property taxes, plus maybe even a little bit more for some of the winter taxes, assuming that your old lender is not currently short on escrow account. And there's no way to guarantee that your current lender is not currently short, but there is a guarantee that if they are currently short and you don't do the refinance, you're going to be making up for those shortages in the near future. So keep an eye on that. Anyway, next, I want to explain the aggregate adjustment amount. Now, you're not going to see this number typically on a loan estimate or early on in stages, but it is something to consider, because when a lender has all these cushions, an extra 2 months cushion, they also have to make sure that the total cushion is never more than 2 months over the 12-month, forward-looking 12-month period. They're never over 2 months cushion in any one of these given categories cumulatively. Now, it's a very complicated calculation, to be honest with you. That's something that you don't really need to worry about. An easy way to kind of get this closer to what you're probably going to see at closing is dropping these to the more realistic, or maybe just adding a 1-month cushion. So doing something like this is going to get us really, really close, and you don't have to worry about the aggregate adjustment. But again, on the closing disclosure, you will see a figure that shows your aggregate adjustment based on the max cushion allowed, and that's going to be a credit back to you. Even though they're collecting a higher amount, that's why you're going to get that credit back. Again, a lot of originators have no idea what that is or even how to explain it, but that's exactly what it is. So if you'd rather see something like this, where it has the 2-month cushion, we can always plug those in and put in the credit of, I don't know, let's say $575. Okay. And so that's going to show you a quick calculation of your initial escrow payments. Now, Carrying all of these figures down, adding all of these together in all these sections gives you the total closing cost, which is D plus I. So I is all of the prepaid and initial escrows and basically all these other costs. They add up to that figure I right here, and including there could be some other miscellaneous costs, which they're one-offs, so they're not very common. But you could see things where you have to pay some type of service fee to the county for water hookup. There could be a number of things. So there's a couple of variables that I can't explain, every single scenario on this video. Otherwise, it would take all day. But there can be other fees or other credits or other things happening, especially in a purchase. But we're focused on refis right now. So this is typically what you're going to see. So the total of all of these figures is going to be this figure, this 5732 in this case, is all of the other costs, which again aren't even costs of doing your loan, except for frankly this tax service of $85 for the recording fees. So you have the $3,500, $3,551 of total loan cost based on the loan that you choose. And then you have all these other costs, 5732. You add those two figures together, and your total closing costs, as they call them here, are 9283. Now this number is very scary, especially because it's not truly your actual cost of doing the loan. These are all things that you're going to pay regardless. But as I mentioned, you should get a big chunk of that back from your current escrow account. And as you bring those numbers forward, now remember we talked about the payoff of $201,041. That was including the prepaid interest. You add these $9,200, and you can see that if you just do your loan for $200,000 in this case, they're going to be short, or in other words, it's going to be a cash to close of $10,000, $10,324. Makes a big difference. So the point is here of $10,324.89 more than what you expected to bring to closing for your refinance. And does it make sense to save, I don't know, $100, $150 a month if you think it's costing you $10,000? Now, here's the flip to all of it. And here's where it really makes sense. What I typically recommend, and a quick, easy way to do all of this is you simply adjust the loan amount. If you adjust the loan amount to the higher amount, so 210 for the new loan amount, you can see your payments, in this case, 1337. You can see that they're not really bringing any money to closing. 351, very little. In fact, you're skipping that one mortgage payment. So let's actually do this. Let's structure this where the borrower's basically bringing that one payment to closing that they would have had to pay for the June 1st payment, make a 209 loan amount, and there you go. They're bringing $1,300 to the closing table. They've got a 209 loan amount. They're going to be getting money back from their current escrow account, whatever that balance is, which then they could apply in a lump sum to the balance, take it from the 209 to 205 after the principal reduction of paying that all down, which is going to save them money and save time on the end of the loan on top of it. But that's one option. Of course, you could use money from savings if you have that available to bring the money to closing and not go that route, and then just replenish your savings when you get that escrow refund. So there's definitely options, but the key is understanding that even though in that scenario of keeping the loan amount at 200,000, well, having the wrong loan amount to begin with makes you feel like the costs aren't worth the benefit, and that's because you have the wrong loan amount. You're not actually looking at the true costs together. So if you look at the actual cost of the loan, in this case, it's $3,500. And if they are saving $150 per month, so let's do this. Let's do the actual cost of the loan. Okay, so in this situation, I'm going to look at the actual cost of the loan, which is that 3,551 figure. And I'm going to look at the monthly savings for this particular scenario. And we're going to determine what is the break-even point, meaning how many months of savings does it take at $150 per month to pay that 3,551? Now, I don't mean literally pay it, but I mean in the sense of the benefit of $150 per month. When does it pay off? So very simply, we just take the total cost savings and divide it by the $150 per month. And and it's about 24 months, which means this particular scenario, if this particular borrower went forward with this refinance, on month 25, they're actually going to be $150 ahead every single month for the rest of the term of the loan. So does it make sense? Well, if they're going to sell the home in a year or two, then no, it doesn't make sense. They shouldn't refinance. They should sit back and do nothing at the moment. If they are planning to keep the home long term, 5 years, 10 years, 15 years, well, then yeah, absolutely. And the longer they keep it, the more benefit it becomes, because $150 per month over, say, 10 years, that adds up to quite a bit. Let's actually look at that. Let's go 120 months, 10 years, it's $18,000 they would save. Well, if they're technically, I should be saying if they keep the home 12 years, because the first 2 years is essentially paying for the refinance cost. Then the 10 years following, they're going to be $18,000 ahead. I don't know about you, but $18,000 would be pretty significant savings to me. And yes, it makes sense. Again, if they're going to sell the home in a year or two, maybe even 3, it might not make sense to do this at all. But here's where people get in trouble, or I should say, people don't look at it accurately. If someone said, well, the costs are, so if someone said, well, the costs are 3551, the costs are, 93,306, which I showed you that this amount here is actually not part of the closing costs. It's not, you're going to pay for that no matter what. Don't do the refinance. You're still paying property taxes. You're still paying insurance. It's just a matter of timing of when and who and where you're paying. But the bottom line is, if the costs come to, if they think the costs are 9306, so say 9306, then the payoff is going to be significantly worse. It's going to take over 5 years to actually have that payoff, that break-even point at $150 a month in savings. So very, very important to understand that the actual cost, the real cost of the loan versus the cost to close the loan and the cost to set up the new loan, and understanding how those pieces come together, it makes a world of difference in determining, does it make sense or does it not make sense? So I hope that this has enlightened you. I hope you feel better, have a better understanding about closing costs on your refinance. If you're in Michigan thinking about a refinance, I'll be happy to run these numbers for you. Just click the link down below. You'll see a get a quote link. That's the best place to start. It's just a real simple 45-second form that you can answer a couple questions. I'll send you out some rates and coordinating closing costs for the lender cost to view. You let me know which one you like, and then I'll give you a full breakdown of what it's going to look like when we put everything together, and you can decide for yourself if it's going to make sense. I'll also walk you through it. I typically shoot a quick video showing my borrowers their cost breakdown, but if you want to jump on a call, we can have something as detailed as this video was, breaking down your exact costs, and I can help you figure out, does it make sense or should you hold off? Because that's really what it comes down to. And if you're worried about having to come out of pocket, well, typically, if you've got the equity, you can typically structure it so you don't have to come out of pocket, and we'll look to see if that makes sense, meaning you don't have to bring money to closing. We can structure it so you can get money back even a little bit at closing sometimes. Or like this example, I had it one single payment, so they don't skip the payment and they want to keep their balance low. Or if you want to keep the loan amount or even lower your loan amount, I've had clients that brought $30,000, $40,000 in to get a lower loan amount just from the start, because they wanted to pay off their home faster and have a lower loan amount. So I'm happy to help structure it and work with you however it makes sense for you. Again, my name is Jim at Treeside Financial. Thanks for watching this video. Oh, and before I forget, to get this entire worksheet, now I'll change a couple things on here. I'll take my logo off, etc. But to get this entire worksheet, so you can just plug in the numbers. I'll have the cells protected, but to get this entire worksheet, you can just plug in the numbers and see how they lay out. Go ahead and drop a comment down below. Drop the comment Treeside Refi down below. That's TREESIDE Refi, REFI, and drop that comment down below, and I'll either reply to your comment or send you a DM, depending on which platform you're watching this video. All right. Thanks so much for watching. Make it a great day. And oh, be sure to check out my next video over here. If you're thinking about refinancing in Michigan, this is definitely something you want to watch. Thanks so much.